You saw the questions that I was going to ask. Hello, this is Mark Sobel. I'm the U.S. Chair of OMFIF. I'm also an advisory board member of the Bretton Woods Committee. Today we're having a joint OMFIF Bretton Woods Committee virtual event. Bill Dudley, who is our guest speaker, is delayed, but hopefully arriving soon. He needs no introductions. I'm also joined today by two colleagues for the discussion. One is a frequent guest and OMFIF favorite, Ellen Mead. Ellen is in the economics department at Duke University. She spent 25 years at the Federal Reserve before that. Before leaving the Fed, she was a special advisor to the Fed Board of Governors and Vice Chair Rich Clarida, as well as senior advisor in the Division of Monetary Affairs. And we're also joined by James Egelhoff. James is chief U.S. economist at BNP Paribas. And in one of his prior lives, he spent a decade at the New York Fed, including leading teams focused on monetary policy strategy and analysis of global markets. Welcome both. I'm hoping Bill will join us very soon. So I guess the place, obviously, to begin is just to get your take on yesterday's FOMC, the statement, the dot plot, the press conference. Maybe what did you see? What surprised you? How does the federal funds rate dot plot, the median, compare with your outlook? So, Ellen, why don't you offer some thoughts on it for us?
Okay, well, thanks.
Bill.
Thanks, Mark, and thanks very much for holding this session and for inviting me to participate. They had widely telegraphed 25 basis point cut. So anticipating that, then you're looking around the edges for other information. The across the board lowering of the dots by one cut over the forecast horizon seems reasonable given the economic developments, particularly around the labor market that we've seen. I think what was interesting to me is to note the Stephen Myron dot there in 2025. But to be honest, the range of forecasts for the variables and for the rest of the dot plot don't look, his particular forecasts are not overly conspicuous from looking there. I sort of half wondered whether we were going to see other descents to the downside, say from Waller or Bowman, and whether that would then generate descents in favor of holding rates rather than cutting. But what we saw was an extraordinary amount of unity, I think. And that caused me to reflect a little bit on what that means. I'm not quite sure I know what that means, but a lot of unity from the other 18 or the other 11 voting policymakers and the other 18 submitting the SEP, although there's a wide range, as we should note, on the dots, yes. And there has been for a while this year that sort of an extraordinary range. But I think, the Fed is a really technocratically oriented place. The discussions are rich. James can attest to this as well. At FOMC meetings, they're very technical, rich, full of data, lots of economic arguments being made, not politics. Very little, if anything, is ever said about politics. And so this political creature, Stephen Myron, was sort of absorbed into that world. And I think you've got 18 other people who are behaving along the norms, the cultural norms that the FOMC has had for years. And it's very hard probably for him, or could be difficult for him to assert himself in perhaps the way he would like. Even though it gives us all pause, of course, that he didn't resign his position at the CEA. So I guess I'll stop there, but I think it's kind of interesting. I thought Powell did a great job in the press conference. There is tremendous uncertainty. We've got the two dual mandate goals really in tension right now. They're still in wait and see mode. So I'll stop there. Thanks.
Okay, well, we'll come back to a lot of those things. James, just picking up on that, anything you want to say, but some people said it was a hawkish cut. There was a decent dispersion, even putting Myron to the side. Any comments?
Yeah, no, I think what we saw from the projections was an FOMC that in the base case is looking forward to an economy that's actually expected to do quite well. Mm-hmm. So they're projecting at or above potential economic growth over the next 2 years. They're projecting the labor market in the base case to remain close to full employment with an unemployment rate that remains quite low. And they're projecting an economy that is showing some evidence of having a persistent inflation problem, with inflation which has already exceeded the Fed's 2% goal for several years, expected to exceed it significantly through 2026. And then we see the Fed somewhat incongruously projecting additional easing. Ordinarily, when you revise up growth and you revise up inflation, you would be taking cuts out of the projections. But in this case, they've added them and they've pivoted towards easing now. So for us, we see this as reflecting two main factors. The first is less about the base case, but more about relative risks. The Fed is concerned, taking the argument at face value, the Fed is concerned that given the amount of cooling that we've seen in labor demand, that this has the potential to take on a life of its own. Now, up to this point, the cooling in labor demand has been matched by a cooling in labor supply due to changes in immigration policy. And in the base case, it appears that they think this is likely to continue. But there's historical evidence that when labor demand cools sharply, as it has, that this can take on a nonlinear dynamic. This is what the SAM rule is about. It's the only relevant macro paper that Powell cited at Jackson Hole. So that's part of the situation. For us, a second and at least equally important factor is that the Fed perceives itself to be under unsustainable political pressure. Nick Timrose, had an article around Jackson Hole where he talked about them being under siege, for example, with the ongoing political criticism from the White House and relatively little support from Congress. And so for us, this likely leads the Fed perceiving that a restrictive monetary policy stance to guard against inflationary entrenchment is not feasible if the cost of doing that is elevated unemployment. So for us, looking forward, we expect an imbalanced reaction function where the Fed prioritizes employment risks over inflation risks due, first of all, to this shift in perceived tail risks, which we think is a lasting shift in their perception, and also due to the incredible political cost, the institutional survivorship risk that comes from pursuing a restrictive monetary policy that could put upward pressure on the unemployment rate. So we think that there's a shift in reaction function here, and we think it's persistent.
Great. Well, thank you for that. We have been joined by Bill. So, Bill, I just started off asking Ellen and James for their take on yesterday. So what about yours take?
Well, my apologies. I had it on my calendar for 10, not 9. So that's why I'm late. Um, my problem is my assistant, me. My assistant doesn't do a good job always. So my take on yesterday was number one, that Paula has control of the committee. A lot fewer dissents than people were expecting. I mostly expected that. I thought that people who were in favor of no rate cuts would defer to the chairman's judgment here, especially when the Fed is under a lot of pressure. I also feel like people tend to defer to the chairman when the disagreement is about timing rather than direction. I mean, if you look at the summary of economic projections, there's no disagreement that the trajectory of rates over the next couple of years is downward. And so we're really just talking about, do we do it in September, or do we do it in October or December? The second thing, I was pleased to see that Michelle Bowman and Chris Waller did not dissent for 50 basis points cut. And that basically tells me that they do care about the independence of the Fed, and they're not necessarily going to do the president's bidding. I think we've been very focused on this issue of the president getting a majority of 4 people on the board of governors if he's able to push Lisa Cook out. And then the concern was these 4 governors could essentially capture the Fed by potentially not reappointing Federal Reserve Bank presidents. And I think the behavior of Michelle Bowman and Chris Waller yesterday suggests that they might not be willing to go along with such a plot. So I was actually pretty pleased by the outcome of the meeting. I think people misinterpret the meeting initially when they saw 3 cuts for this year rather than 2 as the median for the summary of economic projections. But if you actually looked at the dots a little bit more closely, you'd see that there's really no agreement on the committee about whether they should do 1 more cut after this or 2. I read the decision as more of an insurance rate cut, given the weakness in the labor market data, rather than necessarily being the start of a series of rate cuts. It really depends on the data going forward. If the labor market bounces back over the next couple of months, then I think the Fed will sit on its hands. If the labor market continues to deteriorate, then we'll see more rate cuts.
Okay. Well, Bill, let me just ask you about, let's just break down the mandate 2 legs. A lot of focus on impact of tariffs on inflation. My sense is inflation's above 2%. The target's been missed for years. There's a debate about whether to look through tariffs as transitory or not. Steve Kamen tells me a 10% dollar depreciation could boost the CPI by 0.3 of a point. And then we have geopolitical fragmentation, aging, and decreased labor supply. A New York Fed survey puts consumer inflation expectations around 3%. So, where do you think the Fed stands in seeking to hit its 2% inflation target? Whether it's right for the dot plot just to assume mean reversion to 2%, or is the Fed underappreciating the risks to inflation?
Well, I'd probably be on the hawkish side of the fence right now, just for all the reasons that you stated. We're 4.5 years with inflation above 2%, and you can't count on inflation expectations that necessarily staying well anchored. It depends in part on what the Fed does. So this idea that inflation expectations being well anchored allow the Fed to do whatever they want, I don't think that's correct. It's really part and parcel of how the Fed reacts. I think I agree with Chair Powell that the imposition of the tariffs is going to be a one-time rise in the price level. But since it's going to drip into the system over many months, you're going to see elevated inflation for quite some time, and I'm not sure people in the marketplace or consumers and businesses are going to be able to distinguish between a one-time increase in the price level versus a headline inflation number that's running over 3% for probably another year or so. So I would be a little bit more maybe cautious than the Fed is at this point. But I think what's happened is the Fed is concerned that the deterioration in the labor market could end up being self-reinforcing. So last year we had a test of the so-called SOM rule, when if the unemployment rate rises by more than 0.5%, you've always had a recession. And the SOM rule was triggered last year, but there was no recession. But that was because we had very rapid growth of the labor force. So the rise in the unemployment rate last year was due to not the weakness in labor demand, but abundance of labor supply. This year, if the unemployment rate rises by 0.5% or more, I think the SOM rule will actually be pretty accurate because it'll be a consequence of labor market weakness in terms of hiring. The way I think the SOM rule works, basically in practice, is that if the labor market deteriorates beyond a certain point, people start to get worried about their own job prospects, and then they start pulling back on their own spending. What's interesting about the SOM rule is not just the threshold of 0.5%, but what happens if you breach that. When you breach that in the past and had a recession, the smallest increase in the unemployment rate is 1.9 percentage points. So the fact that we've never had a 1% increase in the unemployment rate, a 1.5% increase in the unemployment rate, stopping right there, tells you that there are some dynamics internal to the labor market that once you get it beyond a certain point of deterioration, it tends to be self-reinforcing. I mean, Paul, I think, expressed it pretty well yesterday, what his framework was. He thought that the balance of risk had shifted a bit more towards the labor market, downside risk to the labor market. He still talked about upside risk to inflation. In fact, he implied at one point in the press conference that he thought the risk on inflation were still a little bit higher than the downside risk to the labor market. But he said they were coming into closer balance with monetary policy, in his view, being restrictive. That motivated moving towards a slightly less restrictive setting. Now, I think the big debate is how restrictive is monetary policy, because we have a lot of uncertainty about what R star is. So if the Fed, if the Fed's making a mistake here, it's probably going to be because R star turns out to be higher than what they're thinking currently. The summary of economic projections, median estimate of R star is 1% real, 2% inflation. But if you go back prior to the great financial crisis, you looked at this Taylor rule, it wasn't 1%, it was 2%. So you have 2% real, 2% inflation. In fact, we're running 3% inflation right now. You could argue that monetary policy may not be restrictive at all.
Financial conditions indices certainly don't look restrictive. So when I put it all together, I'm not a monetary policy expert. I was just a treasury guy. How do you balance these two things, these two legs of the mandate when they're headed in opposite directions? If I look at the dot plot, it basically says GDP is at potential, and they marked up the forecast for this year on GDP. And unemployment, 4.5 and this year, but basically it stays under 4.5 in the horizon, and that's a pretty good number. That's probably below where a lot of people thought NAIRU was. They've marked up inflation for next year, getting them further away from the target. So a simple person would say, well, the Fed funds rate should have remained steady or gone up, but it doesn't add up on a simple overview of the data.
Yeah, and he got asked about that at the press conference repeatedly. I mean, I think the issue here is it's not about the model forecast; it's about risk around that forecast, and that really underscores one of the weaknesses of the summary of economic projections. It focuses everybody on the modal forecast. And in fact, the summary of economic projections, as Paul talked about yesterday, it's just a collection of individual forecasts. They're not coordinated in any way. So I think this is a risk management interest rate cut. Rather than a cut based on changes in the model forecast, and that's difficult to explain that distinction, I think.
But that begs the question of how much farther there is to go.
I think there is an open question how much farther there is to go. The summary of economic projections too also is based on your optimal monetary policy based on your forecast. Now, the forecast you make is probably not going to turn out to be accurate, and so the optimal monetary policy that you ultimately embark on will be probably very different than what you write down in the summary of economic projections. I think we take the summary of economic projections a little bit too literally, especially when we're talking about beyond 3 to 6 months time horizon. You go back and look at the accuracy of the summary of economic projections, more than 6 months out, not very accurate. No forecast.
I was trying to get Bill Dudley to tell me where his dot would have been. I
probably would have been in the camp of not cutting rates this meeting, but if I was the vice chair of the FOMC, I would have gone along with Chair Powell's decision to cut by 25 basis points. The New York Fed president, goes along with the Fed chairman. The New York Fed president has the opportunity before the meeting to try to convince the chair this is what we should do. But if that person doesn't succeed in that effort, then that person goes along with the chair at the meeting.
And would the former New York
At least
Fed
that's
chair have
my experience.
supported would the former New York Fed chair have supported two more rate cuts this year? Yesterday?
I probably would have had one more in the forecast. Yeah, the summary of economic projection though isn't coordinated. So the New York Fed summary of economic projections could be different than the chairs.
Okay, well, let's keep moving on. A lot of talk about central bank independence, given the Trump attacks, Myron's appointment, Lisa Cook, Scott Bessent's recent article. You spoke a little bit about this up front, and mentioned that Waller and Bowman stayed with the consensus. How worried are you about central bank independence? Is it seriously in jeopardy, or is there more noise in the debate?
I'm very worried about it myself. I mean, what President Trump is trying to do vis-a-vis Lisa Cook is unprecedented. No president's ever tried to fire a sitting Fed governor. And the pretext for the firing that doesn't seem to be very strong because it's not about something that she's done poorly in her job. People have interpreted for-cause dismissals as requiring malfeasance and dereliction of duty in the conduct of one's job, not something that happened outside of their job. And the facts of the case have not been established. I mean, I think it's just remarkable that one of the three court appeal justices agreed that Cook be fired without actually her having her day in court. I thought that was just quite remarkable. And it makes me concerned about what's going to happen when this case goes to the Supreme Court. The second thing I would say here is even if President Trump doesn't succeed in dismissing Cook, it indicates intent. And just because this gambit didn't work doesn't mean there might not be other ways to gradually take control of the Fed. So I think the intent here we need to take very seriously because if this were to succeed, we would have a very different monetary policy. And I think Steve, the outlier dot plot reading yesterday that almost certainly was Stephen Moran's dot tells you where monetary policy would go if the Fed's if Trump put his lieutenants in charge of the Federal Reserve. It'd be a dramatically lower path for short-term rates, almost certainly cause the economy to overheat. And we basically would get out of our fiscal problems by low interest rates and higher inflation. And I think that, frankly, would be pretty unpopular with the population. I thought one of the big lessons of the last election is people hate inflation. So if you really think about, if we're going down this path of Trump gaining control of the Fed and much lower rates and higher inflation, I'm not really sure that it's a politically winner either from a point of view of policy. Better to bash the Fed and not have control, and then if things go wrong, blame the Fed for what went wrong.
Well, okay, that brings me just to a last
Ellen
question.
Ellen has an interjection.
I was going to, okay.
I was going to say, unless you stop publishing data on inflation.
Yeah, that's a risk. Although I guess I'm less worried about that than some people because it feels to me that there's so many alternative sources of information on prices. Sort of like, with China, do we believe the Chinese real GDP figures when they, forecast 5% always sort of hit their target? No, but people still develop views about the Chinese economy independent of the official numbers. So yeah, I think it'd be, obviously a bad outcome if the BLS credibility is corrupted and we can't trust the BLS numbers. But I think that wouldn't deter people from trying to figure out what's really going on. And, people do go to the grocery store, they do shop, so they actually do see the prices that they pay. So I think, corrupting the BLS seems to me also a really bad strategy because it would just move you much closer to that point where people had a total loss of confidence. You'd end up with, I think if you go down this path, you're talking about a Liz Truss moment in the United States where the bond market basically says we're not playing anymore, and the dollar goes down really sharply. I mean, we really do depend on the kindness of strangers to hold a big portion of our debt, and we've been very fortunate that the dollar has been the reserve currency and has had that status for very many years. But that's not guaranteed. I mean, if we follow policies that destroy our credibility, then people are going to look for other assets to hold rather than dollars. And you could go from everything's fine to everything's horrible pretty fast.
That pretty much begins to make good headway into the last question I was going to ask Bill before turning to Ellen and James. It's a question about our high fiscal deficits. I think CBO is projecting 6% of GDP deficits as far as the eye can see, which is a lot of paper to be dumping on the market. So should we be concerned about debt deficits putting upward pressure on medium and longer term rates, and perhaps even forcing the Fed's hands to use financial repression, quantitative easing, YCC? Should we be worried about that? And our mutual colleague friend Meg Lunsager put a question to me yesterday, a variant of this, to ask you about, should we be fearful of the bond vigilantes showing up anytime soon?
Well, I certainly think we should be fearful of the bond market vigilantes, or maybe not fearful. I mean, the bond market vigilantes might be the disciplining mechanism to get us on a better policy path. So I'm not so sure that I'm so negative about the bond market vigilantes showing up. Look, I think fiscal dominance really depends on whether the Fed plays ball or not, right? And that depends on the independence of the Fed. The administration's, I think, program with respect to fiscal policy is really twofold. One, rely a lot on tariff revenue, and it's uncertainty where we're going there because of the court ruling about IEEPA that 2/3 of the tariffs that have been put in place are currently at least illegal until this gets settled at the Supreme Court level. So that tariff revenue is not going to be forthcoming over the near term. We'll see what happens over the medium to longer term. And two, they want to get interest rates down because they're very aware that debt service costs are going to rise pretty sharply over the next 10 years. If you look at the CBO projections, there's a 1% increase in debt service costs over the next 10 years as a percentage of GDP. There's a 1% increase in spending on Social Security as a percentage of GDP over the next 10 years as the baby boom generation retires, and the same thing for Medicare. So if you're not willing to raise taxes, and the only place you're willing to cut spending is domestic discretionary spending, it's really hard to get from here to there. Now, the other thing they're hoping is to grow the economy much faster. But if you clamp down on immigration and you increase the rate of deportations, you're lowering the top speed of the economy significantly because you just don't have the labor to grow the economy at the rate that you have in the past. 2024, we're probably growing the labor force about 1.5%, 2% a year. And this year, we'll be growing the labor force somewhere between 0.5% a year. That's a big downshift. So potential GDP growth has fallen a lot just because of the changes in labor supply. Now, maybe AI will bail us all out and we'll have this productivity miracle from AI. And I think AI is going to be important, but I'm not sure how fast that plays out and how much the productivity benefit will turn out to be.
Okay, let me turn to Ellen for a few minutes of comments, basically anything you want to say about what we've discussed. And then Ellen, the framework review was recently concluded. You've written a lot about communications. I understand some of the communications outcomes have been put off for later this year, but could you, in addition to any general points you have, just offer some thoughts on the framework review and the SEP as a communication tool?
Sure, thank you. Well, I think before Bill started speaking, I had offered some comments on the meeting yesterday, so I might not say more about that. I totally agree with Bill's concerns around independence of the institution and the unprecedented things that have been going on many fronts, right? First the attacks on Powell, then the building shenanigans over the summer, then the Lisa Cook. It's like they're reaching from one thing to the next. Now we have Myron not having resigned the CEA role. So we go back to pre-1935 in terms of a participation from an administration official in FOMC meetings, and, potentially even a violation of other norms yet to see. But I mean, I think it's a multi-pronged approach to attacking independence. I've been surprised that the markets haven't been more worried or haven't shown evidence of greater worry. I don't know whether it's good or bad, but I thought that Powell handled himself in those kinds of questions very well yesterday. The Fed has to just remain focused on its job and so on. On communications, so I started writing on Substack over the summer because I wanted to respond to the Bernanke proposal that was put forward at the Fed's Framework Conference in May, and also to Bill's Group of 30 report, which were largely in line about the virtues of publishing the Fed's staff forecast. I totally agree with the points about the advantages of having a forecast out there with a modal outcome that's fully fleshed out, and then you run alternatives around it and you make great use of those alternatives in telling your story. You know, what is a forecast? It's a story, and you don't just want one story, because in a world of great uncertainty, you have a number of plausible stories and you need to be able to talk about them concretely, and that's the whole point. I think, I totally agree with all of that. Where I took a different view, and Bill and I have emailed about this a little bit, was just around the publication of the staff forecast, which has a number of input assumptions around fiscal policy, around other government policies. An example that I think is resonant is in the December 2016 forecast. The Fed staff incorporated Trump tax cuts. He was elected at that point, but not president. Was it a solid enough piece of information, without being any proposed legislation, that you should put it in the baseline versus as an alternative simulation? I think those are decisions that policymakers need to make about where those forecasts, where the assumptions lie, and what's an alternative and what's the baseline. And so that would be a very different sort of way of doing the forecast than the Fed has now, but I don't think it's insurmountable. I mean, if you look at what the ECB does, with a chief economist as a policymaker who interacts with the staff and is handling those kinds of decisions that maybe breach the political level. You don't want the Fed staff's head of research and statistics being hauled before Congress to justify why a fiscal assumption went one way or another. And I think that's really what I was reacting to, but not the overall view. So I think it's going to be very interesting to see what they come up with. And I'm expecting it at the December meeting. Powell's strongly suggested that's what they'll do. It looks to me from what they've said that they're going to try to reform the SEP in some way, as opposed to have another competing forecast that comes out of that staff process. I think one thing that came up yesterday, and this will be my last point, was the question around an independent review of the Fed. I can't remember which journalist asked that. Powell clearly did not think that was necessary. You look at the Bank of England, they've had a history of requesting independent reviews from experts on specific topics. So the Bernanke last spring issued the independent review around forecasting and communications. There have been earlier independent reviews. Don Cohn was asked to do one, Dave Stockton. They've had a number over the years. It's very specifically targeted. Could the Fed benefit from something like that? Yeah, I do think they could. And in a world that wasn't so filled with all this sort of political business and threats to independence, it might well be time for the Fed to engage in a process like that. But I just don't think anything really helpful could come out of that right now. So just going to stop.
Okay, James, thank you for joining us. Just any comments on Bill's points? And let me just throw at you a question on Fed balance sheet policy. Are we in an abundant or ample reserve space now? And are we approaching a point where the Fed needs to consider halting its runoff of treasuries?
Sure. And again, thank you for the opportunity to join you and to be in Bill Dudley's company again after quite a long time, having worked for him for my entire run at the New York Fed. I think the key thing here is that we're going to live in very interesting times. And our base case economic outlook with the Fed's pivot yesterday, which we had expected, we are looking for the economy to enter next year with growth holding up well, with a labor market that remains at or close to full employment, with inflation that is persistently and significantly above target, and for monetary policy to be moving into a moderately accommodative stance. For us, this makes it, it boldens us. It gives us greater confidence that the economy is remaining in a soft patch, that it's not moving towards recession, and that there is an incipient, persistent inflation problem that is unfolding. Hear Bill Dudley's point on perhaps the committee wanting to retain more optionality on easing, which is currently in the SEP. I think that it will likely be challenging because it will be difficult to remove the pricing from the market. Moreover, from where I sit, I'm unconvinced that this is what the center of the committee wants to do. We have, while we've been speaking, Nick Timrose, who writes for the Wall Street Journal and is viewed rightly or wrongly as a conduit for semi-official information, was tweeting reinforcing that 3 consecutive cuts are likely. For us, the base case outlook will give the Fed significant pause as we go into next year. I think another feature of this that's important is about the reaction function going forward. We tend to see the reaction function as being asymmetric. So if we were to see evidence of accumulating labor slack, if we were to see the SAM rule, which Bill referred to, having to appropriately trigger in this environment, we could see the Fed very easily responding with overwhelming force, with consecutive 50 basis point easings to get monetary policy clearly into neutral or accommodative territory. Whereas we tend to see it as being much harder to pull back on the course that has been laid out yesterday, with the concern about relative tail risk that Bill highlighted, and also the likelihood of overwhelming political pressure that we would see in response to any hold meeting, making that type of pivot much more challenging and costly for them to execute. But on the independence topic is one that I have client conversations with multiple times a day. It is not a new topic. It goes back to Liberation Day and the threats to remove Powell that came up during that period. For us, it takes 2 forms. One is the concern of a Wile E. Coyote moment, of an abrupt event that causes markets and the public to lose confidence in the Fed and its ability and willingness to pursue appropriate monetary policy. And the other is more of a gradual erosion, more like the 70s, where the Fed it pursues an imbalanced reaction function, deprioritizes inflation, and where long-term inflation expectations gradually rise over time. For us, we're not expecting the former case, so we believe that the vast majority of the candidates that have been surfaced for chair are committed to the 2% target and are likely to be reasonable. I think we also, we take note of the fact, as Bill and others have mentioned, that the current Republican appointees on the board were in the majority in this meeting. That gives us some solace that the institution is in base case stable. That said, we have more concern about the gradual erosion argument. This is something which will play out, gets played out already to some extent over the past few years and has the potential to play out further. Finally, on the balance sheet, we believe that we are in an ample reserves regime. We think the right way to think about it is the balance sheet size relative to the total bank assets in the economy, and that remains at a relatively elevated level. A lot of this ultimately becomes about preferences going forward, and a lot of it will turn on the preferences of 2 particular policymakers, Governor Waller and Dallas Fed President Logan, who are the 2 who have focused most on this topic. And both of those seem comfortable continuing runoff for a while longer. Our current base case is that they start to taper back again in December. But there's a judgment, a preference to get a bit smaller, both due to political preferences that were in Project 2025 and elsewhere for a smaller Fed footprint, and also to preserve firepower for any future crisis that might come. So we're expecting runoff to keep going for a while longer, but we could see that starting to wrap up as we get closer to the end of the year.
Thank you very much for that. Ellen's got a 2-hander.
Yeah, I'd like to follow up on that asymmetry point, and I'm wondering what Bill thinks of this. So the Fed took the explicit asymmetry around the unemployment mandate out of the framework statement, but said some very interesting things. Powell said something in his speech about, we still believe that asymmetry may be important, but we didn't communicate it well in 2020. I totally agree with that comment. But in 2020, they moved to this asymmetric shortfalls wording because of the missing of the U-star goal on the downside so many times in a row. They felt very unconfident, lacking in confidence about moving rates. It's a risk management thing. And in 2020, they shifted how they saw the risks around doing that. I wouldn't say that they have an asymmetric reaction function now. You have to look at what the weight is on the unemployment gap versus the weight on the inflation gap. And of course, what the committee's weight is a weighted average of what each individual's reaction function is, or maybe better, it's just with a heavy weight on the chair's reaction function. And they're, whether you take the Taylor 93 weights or the balanced approach rule weights or whatever weights you have, they could need to move or decide that their preference is to move very, very quickly to address labor market outcomes. It's not an asymmetry, it's a weighting. And when the gap gets big, you just go for it. So I disagree with the asymmetry statement. I do think they could move very, very quickly if you get a SOM rule-like adjustment, as we've seen in the past, they could move very quickly to address that.
Bill, anything on that since she directed a question at you?
I mean, I think that the difference between inflation and unemployment is that inflation, you see what number you have and you know what your target is. So there's no ambiguity about where you are relative to where you want to be. The problem is you don't really know what full employment rate is. And you don't really know what U-star is. So you don't want to make a guess about U-star and inadvertently put people out of work that you don't have to. And so I'm actually quite sympathetic with the notion of trying to probe to see how far you can go in pushing the unemployment rate down before you start to see a rise in inflation, because you certainly don't want to have a monetary policy that's keeping people out of work unnecessarily. And I think that's the difference. So I think the Fed still is in low inflation environments, the Fed is still going to be willing to sort of see how low they can get the unemployment rate. When the inflation is higher, like it is today, then I don't think their ability to probe is really open to them, because if in those cases, if they probe and it turns out that the U-star is higher than they thought, then they're going to have even more inflation. So I think it really depends on the economic environment. I think the big change that they've made in the most recent monetary policy framework is just to go back to the old regime of 2012, where policy can be preemptive again. I mean, the big mistake I think in 2020 wasn't just the framework, but was how they operationalized it. Yes. They basically said we can't lift off until inflation's at 2%. We're confident it's going to be above 2% in the future, and that we're at full employment. So you had this crazy circumstance that the economy was overheating, we were at full employment, and interest rates were still at zero. So there's a big gap at that moment between where you were and where you needed to be. And I think the whole change is back to where we were basically in 2012. I mean, the words are different, but the import is the same, is to allow monetary policy to be preemptive. I mean, I think that, with the benefit of hindsight, where we were in 2019 wasn't so bad. We were basically at full employment. The monetary policy was essentially at neutral, and inflation was a couple tenths below the Fed's objectives. I mean, that seems like a nice place to be. And the advantage of having a preemptive monetary policy is it makes the economy less cyclical. There's less chances of being late and having to slam on the brakes and then generating a recession.
But don't you see the preemption as coming, and I agree with you on that interpretation, but don't you see the preemption as coming directly in the face of the shortfalls approach, which, as you've rightly articulated, if you don't really know where U-star is, why put people out of work? So in a low inflation environment, as you were in 2020, maybe you can afford to probe that, as you said, and you aren't are you giving up preemption? I personally, having worked on that statement in 2020, didn't think they were giving up preemption. It was only ex post, with the forward guidance and so on, that it seemed that they had kind of.
I think the big issue in 2020 was, the concerns about, getting pinned at the zero lower bound. Those risks were clearly viewed as elevated, and they were elevated because real rates were low and inflation was below 2%. And so there wasn't a lot of room for the Fed to cut rates. What's interesting, I found out in my conversations with some of my Japanese colleagues on the group of 30 is they didn't think that it was such a big deal of being pinned at the zero lower bound. So their view is that the Fed overweighted the consequence of the risk of being pinned at the zero lower bound. And they lived there for many, many years. And the Japanese economy actually performed reasonably well over that period. So another, I think, open question is whether being at the zero lower bound is quite as bad as it's been viewed to be.
Okay, so we have about 8 minutes or so. I think there's like 4 types of questions that have come in. The first set is political. How do you know if the board is blue or red? What can the White House do to pressure the Fed besides mean tweets or social truth things? And is it possible that other appointees could get captured by the spirit of the FOMC? The Waller-Bowmans become institutionalists. Anyway, so that's the first set of questions. Any comments on kind of those political issues?
Well, look, I think, I don't think it's being captured by the Fed as an institution. It's recognizing that Fed independence leads to better monetary policy outcomes and better economic performance. So I don't think that's a blue or red question. I think what's sort of interesting from my perspective, that President Trump wanting to, take over the Fed and compromise the Fed's independence. I'm not sure that's a good policy, from his perspective. Because if he does it and the Fed follows a very, expansionary monetary policy as he has proposed, you're going to have a bad economic outcome, and he's going to own it. So I'm not really sure why this is the desired path.
Okay. Question about distribution. The K-shaped economy. Should the Fed pay attention to U6 more than U3, or weight U6 more heavily? Any thoughts on that?
I think, right now we do have sort of a two-track economy, right, where people at the low end of the income distribution are getting squeezed. That's where the tariffs and the tariff pass-through really bites. And they don't benefit from the easiness of financial conditions that we see in terms of the, for example, the strong stock market. So there really is a tale of two economies right now. But, monetary policy is not, people, I think, sometimes exaggerate the power of monetary policy to handle certain kinds of issues like distribution issues. That's not really something monetary policy is good for. That's really something for the Congress and the fiscal authorities to deal with. That's about education programs. That's about child care. That's about access to have transportation so you can get to where the jobs are. Those are things that the Fed can't do very much about. So I think. The Fed, I think, is very aware of it. And I think, the Fed is also aware that it sort of hurts the Fed reputationally, because when the Fed follows a policy that leads to a soaring stock market, but those gains don't trickle down to the lower end of the income distribution, the Fed is then characterized as conducting monetary policy for rich people. And I don't think that's what the Fed's doing. But it's easy to characterize it that it's just that monetary policy is a very blunt instrument, and it doesn't have that ability to make, subtle income distribution outcomes different.
They certainly do monitor the U6, though, right? It's on the dashboard of the many labor market indicators.
Yeah, and I think when you have people who are discouraged, and not seeking a job, that just tells you that there's another set of people that would like to work that are available, and so I think U6 is a perfectly reasonable thing for the Federal Reserve to track, and as Ellen points out, they do.
Obviously, the dual mandate is set by Congress. We have a dual mandate in the U.S. I kind of think that's culturally where the U.S. is. So your ECB has a single mandate. And any views on mandates? And if we had a single mandate, would that have changed yesterday?
So, we actually have three mandates, as people have pointed out recently, Scott Bessett and I think Steve Moran. It's also there's a third piece of the Humphrey-Hawkins Act which talks about moderate long-term interest rates. And Powell was asked about that yesterday. What about the third mandate? And I think he responded, appropriately. Yes, there is a third mandate, but basically we don't think about that very much because if we take care of the first two mandates properly, the third mandate automatically takes care of itself. So the Fed would obviously prefer to have long-term interest rates moderate and knows that if they follow the right monetary policy course, keep inflation in check, economy at full employment, they'll be able to do so. Look, I think the reality is there's not as much tension here between having two mandates and one as people think, because as Fed chairman, not just Powell, but Yellen, Bernanke, and others have said, if you don't have inflation expectations well anchored, you don't have inflation at 2%, then it's going to be very, very hard to achieve your full employment objectives. So the dual mandates are not as much in conflict as people seem to think.
James, any quick views on that?
Yeah, I think where this conversation about the third leg of the dual mandate comes up is with respect to what the Fed would do in a future fiscal crisis, where there was to be some increasing concerns about debt sustainability, and where you were to see the long end of the Treasury curve sell off. You were to see 30-year interest rates rise sharply. Those who put a great deal of importance on the third leg of the dual mandate tend to argue that in that type of environment, the Fed would likely intervene aggressively with asset purchases to stem the rise in yields and mitigate this fiscally induced increase in risk premium. There is a long track record of the Fed doing things that are adjacent to that, and so this. The intervention in mid-2020 with QE was arguably initially about cleaning up excess foreign reserve manager selling and avoiding an inappropriate rise in long-term yields that wasn't justified by macroeconomic fundamentals at the time. Chair Powell was asked about this in an appearance he made in Dallas late last year, and he responded in a sort of unclear way that left a lot of optionality open to engage this type of intervention. But in the environment that we're in, with a high debt, a high fiscal deficit, and with some unconventional policies being proposed, and particularly by Mr. Moran, this issue of how the Fed could step in to take the tail off of some of these adverse scenarios is becoming very important. And some of these arguments are about the Fed. The Fed is appropriate it's appropriate for the Fed to do this if we were to get into that situation.
Yeah, my view is that the bar for the Fed doing something to just in response to bond yields rising is really high. I think the bar for the Fed doing something because markets are dysfunctional and disorderly, the bar is much lower. So I would be very surprised if the Fed said, oh, gee, if bond yields were going up in a relatively orderly way, the 10-year yields were 5%, 6%, if that was happening in an orderly way because people were unhappy with the fiscal prospects of the U.S., I don't think the Fed would do yield curve control or anything like that. Yield curve control is a monetary policy instrument used at the zero lower bound when you don't have another means of providing additional monetary policy stimulus. Yield curve control is not designed to cap the government's borrowing cost because the government is on a fiscally profligate path. I think yield curve control can work very well when you're in a very sluggish or recessionary environment because you basically are taking risk out of holding that asset because you're reducing the volatility and price of that asset by pegging the yield. But if the Fed were to in an inflationary environment where fiscal policy was on an unsustainable course, tried to cap the treasury market, they would end up owning a lot of treasuries, and the market would lose confidence. They would basically say fiscal dominance. We are now at the point of fiscal dominance. And I think that would be sort of game over in terms of the U.S. having the confidence of the rest of the world in managing its economic affairs. So I think the bar to doing that is really, really high. Now, if it's just disorderly markets, absolutely, the Fed could come in and do treasury interventions, and we saw that in the Dash for Cash episode in March of 2020. So I think you have to distinguish between market turbulence that presumably is going to be relatively short-lived versus a systematic rise in long-term yields due to economic fundamentals.
So let me, okay, two things. One, I'm just going to observe for another day that the lines between monetary policy and financial stability can be blurred. And secondly, lightning round, quick question to do justice to the questions. Any thoughts on the current Fed's policy situation and emerging market spillovers, gold markets, things like that?
Well, I just think that right now everything is pretty darn frothy. When I see companies out there whose business model is to issue debt and equity to buy Bitcoin, and then people value those companies at a premium to their Bitcoin holdings, I think we're in a fairly frothy environment. Financial conditions today are the easiest they've been since 2022. Now, obviously, that's not independent of people's expectations for the path of monetary policy. So if all of a sudden the Fed said, no, we're not going to cut rates to 3% over the next few years, financial conditions would tighten abruptly. But it seems to me that financial conditions are quite easy today. And it raises, in my mind, the question of are we really going to need as much monetary policy accommodation as the market's priced in, assuming the labor market doesn't break? I mean, that's the $64,000 question. If the economy strengthens a little bit from here and the labor market's stable, I don't think we're going to need a lot of monetary policy accommodation. If the labor market continues to unwind, we get an unemployment rate of 4.5%, 4.6%, then of course there's going to be a lot more monetary accommodation. So in my mind, there's sort of two paths. One path leads to very little further accommodation. The other path leads to quite a bit more accommodation. And I think it's not clear yet which path we're going to be on.
Well, thank you for that. We've gone a few minutes over. So Ellen's got a 20-second two-hander.
Yeah. So just wondering, we haven't talked about when we think the next financial crisis will be, but to layer on top of what Bill was talking about, we have a huge push into crypto. We have a huge push to outside the banking sector to put private equity into retirement plans, to deregulate broadly. So when is it coming?
Great question. And one of my hobby horses is that the Democrats and the Republicans, neither of them have done enough to contain non-bank financial intermediation and some of its linkages with the banking system. A great topic for another discussion with you guys one day. So let me wrap up. Thank you. We have got a lot in. Thank you, Bill Dudley, Ellen Mead, James Egelhoff. This was a great discussion today. Thank you for audience for joining us. Thank you.
Bye.